In this presentation, we will discuss types of income that are excluded from gross income, including fringe benefits. Remember, the definition of income, in essence, for the tax code is that everything that's received, basically everything that is income, is going to be included in income unless specifically said otherwise. So some of the things that are going to be specifically said otherwise will be things like fringe benefits oftentimes. Now, when we think about the data input at the end of the year, the fringe benefits might not have too big of an effect. The things that are not included in the taxable income might not have a big effect to us because they've already been considered and have been reflected, therefore, in the related documentation such as W-2 forms and so on and so forth, oftentimes generally. However, they're going to be something that we want to be aware of because they're really helpful for us to be able to talk to the client about these items, and they're going to be good for tax planning purposes. Remember that we want, if at all possible, we would like to not include income into the taxable line of income. So anything that the code says, hey, this is something, a form of income, a form of like compensation that can happen that we're not going to tax you on line 1 of our formula here. If we can exclude it from line 1 of the formula, we would like to do so. So if we see some of these fringe benefits, if we see some of these items and we say, hey, you know what, if this is something that your employer could provide you with, they might be able to give you some form of compensation. And even if they lowered your income and provide you with this compensation in an equivalent value of some type of benefit, then you would be better off. Why? Because now you're receiving a value of the income and you're not having to pay taxes on it, because these are items that will be excluded. So these are things you could mention. You want to basically keep in mind and say, you know, are these things that your employer might want to consider? They can pay you or compensate you in these types of ways to add to your compensation, hopefully, or at least even if they deducted your compensation and gave you the fringe benefits of an equivalent value, you would typically could be better off because you're getting that value and you're not going to be taxed on it because it's a benefit of income you're receiving that's not required to be included in line 1 of the tax return. Therefore, you shouldn't be paying the federal tax on it. Fringe benefits, and for more detail on this, you can take a look at publication 15B. We'll include 15B publications. You can also find it on the IRS website at irs.gov. Exclusion rules that apply to fringe benefits. These rules exclude all or part of the value of certain benefits from the recipient's pay. So they're going to exclude it, in essence, from the recipient's pay. That means that they got income, but it's excluded from the recipient's pay for the reporting of wages on the tax return, and therefore resulting in a lower income, resulting in a lower taxable income, which you'll then apply the tax rates to, which will result in a lower tax. In most cases, the excluded benefits aren't subject to federal income tax, withholding, Social Security, Medicare, federal unemployment, which is FUTA tax, or Railroad Retirement Tax Act, RRTA. Taxes aren't reported on Form W-2. Publication 15B discuss exclusion rules for the following fringe benefits. So you can, again, look at that publication 15B for more detail. Here's a list of fringe benefits you can look into. Accident and health benefits, achievement awards, adoption assistance, athletic facilities, de minimis or minimal benefits, like kind of small benefits typically, dependent care assistance, employee discounts, employee stock options, employer-provided cell phones, group term life insurance coverage, health savings accounts, lodging on your business premises, meals, non-additional cost services. We got the retirement planning services. We have the transportation, commuting benefits, tuition reduction, which could be beneficial, working condition benefits. Note that most employers are aware of a 401k plan or a retirement type plan, and that's going to be a huge benefit that an employer can provide. But some of these other benefits may not be so well known, so if you take a look at those and some of those are applicable, they might be something to consider with your employer as well. Other non-taxable income, gifts and inheritance. Now, when you think about gifts and inheritance, you're not typically going to have a form for the gifts and inheritance, but you might have people questioning about gifts and inheritance. They're going to say, I've received some money for a gift, or I've had some type of inheritance, or I gave a gift or something like that. What are the tax consequences on that? Now, the gifts and inheritance are kind of packaged together One reason for that is there's going to be an estate tax that could be applied. So basically, when you think about the income tax, what we're usually doing for the tax purposes is taxing people as they earn income. So if someone earned income and then they died and passed it on to somebody else, that's not really earning income. That's a gift. You're giving what you have earned to someone else. So you would think in that case it wouldn't be taxable because it's a gift. It's not earned income. There was no transaction. There was no bartering situation. Nothing was received for the gift, and therefore it would just be a gift typically, and you would think it would be a non-taxable transaction for an income tax structure. However, there is a kind of tax on it, which would be an estate tax, or you might call it called a death tax, right? When they die, someone dies, and you would count up all the assets that they have, and if you are going to tax them, which would be a high threshold, and it wouldn't be an income tax situation, but then they would then add it up and see if the tax would apply to the estate at that point in time. So in essence, the bottom line is the estate would be taxed at the point of death, and typically then the inheritance shouldn't be taxable. So the bottom line is when you're doing the tax preparation, typically the inheritance is not going to be taxable. If they don't have a good lot of money, they're pretty wealthy, then they're probably not going to be subject to the estate tax, may not be subject to that, and therefore it wouldn't have an effect. That's a kind of income you would have that wouldn't have it. Now, if it was a gift, then there's some gift limitations, but the gift limitations don't really typically have an effect on the income tax preparation. They limit the amount of exclusion you can have on the estate tax. So if there's a large gift, then that could limit the exclusion on the estate tax. So you can get into a lot more detail on estate tax. That's generally an issue for more wealthy individuals. Bottom line, though, inheritance and gifts, for the most part in general, will not be included as on the taxable line of the 1040 typically. So then we have the life insurance proceeds. So a general rule for life insurance then, if you got the proceeds for the life insurance, then general rule, that's not included in income and the tax return. Scholarships and fellowships. So if it was a scholarship that was received, then you're still going to get documentation for it, but it'll typically be a scholarship. And if it says it's a scholarship or fellowship, then that's something that will typically not be included in the income. You may still get documentation on the scholarship or fellowship from whoever provided those. And then we have the qualified tuition program withholdings, so not included. We have the compensation for sickness or injury. So if you have compensation related to sickness or injury, these items oftentimes will be reflected in the documentation. Therefore, it'll be basically reflected on the W-2, and therefore, hopefully, the data input forms that we have already will be filled out properly, and we can just use the data input forms properly filled out with regards to compensation for sickness and injury. Child support. This is kind of a big one when there's a divorce. You want to basically have an idea of whether something is alimony and child support. Now, the alimony rules have changed as well, so you have to think about when the divorce happened. But the bottom line is that if it's child support, no matter when the divorce happened, then it's something that's not going to be included in income. So if one individual is receiving the child support, then it's not going to be included in income even though they're receiving the child support, and the other individual typically that is paying the child support is not going to get a deduction for the payment of the child support. Alimony is a little bit different depending on the circumstances, because there was a change to the law last year, and we'll discuss that a bit more later. Welfare, and then the employer provided adoption assistance. Again, items that should be within the documentation received, already included hopefully in that documentation. For example, the employer provided adoption assistance hopefully will be reflected in the W-2 form properly, and therefore with the data input of the tax return should be fairly straightforward.